I think there's this is repeated ad infinitum, and 4-year cycle, 4-year cycle, 4-year cycle. There are certain tropes that keep getting repeated. I think it has its origins in the fact that Satoshi implemented the halving. 50% of all the Bitcoin that will ever exist was mined in the first 4 years. Bitcoin's been going up about 45% a year for the past 5 years. I expect it to go up 30% on average for the next 20 years. It was going up 80% on average 5 years ago, so it's decelerating from 80 to 70 to 60 to 50 to 40, and it should continue to decelerate towards something like 1.5x the S&P. And so it's not hard to get to a forecast of about 30% over 20 years.
Bitcoin is no longer hiding at the edges of global finance. It has surged straight into the center of a historic transformation of money itself, and the implications are becoming impossible to ignore. The headlines focus on price rallies and institutional accumulation, but a far more explosive shift is unfolding underneath everything. A financial system built on decades of leverage, debt, and constant money creation is coming apart, and no bailout, stimulus, or rate cut can stabilize it anymore. Something must give, and by 2026, Bitcoin may stand as replacement. But here is the tension. As Wall Street tightens its grip on Bitcoin and engineers layered products around it, massive questions erupt. Will Bitcoin remain the decentralized asset it was designed to be? Or will it be reshaped by the same fragile system it was created to outgrow? The answers are arriving fast, and they will determine whether this phase becomes true liberation or just another illusion of progress ahead now. Michael Saylor says credit markets are breaking down right now, and an entirely new framework is quietly forming to replace them. He argues that bonds and savings accounts can no longer protect wealth because yields collapse while inflation relentlessly erodes purchasing power. He believes digital capital is the only exit, capable of generating double-digit returns with lower risk, forcing one staggering question about where Bitcoin's price could sit in 2026 when global confidence finally snaps. Sit back as we bring you more clips from Michael Saylor's interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
There was just a snarky headline in Reuters where they said Bitcoin hoarder strategy remains in the NASDAQ 100. And it was like fake news because there was never any intention of removing us from the NASDAQ 100. And it's kind of like it's a backwards kind of insult to suggest that the company just hoards something, and just reminds me of what is the insult of people doing anything intelligent that you don't understand. You just call them hoarders, like the people that hoard food when everybody else is starving to death or whatever. They think you might need it. But yeah, we're not a hoarder. What we are capitalists. So the most fundamental premise is Bitcoin is digital capital, and a lot of the traditional finance establishment doesn't understand capital. And so they don't recognize a capital asset when they see it. So we're acquiring Bitcoin as capital the same way that you might acquire 3% of Manhattan. So say you believed in Manhattan and you go and you buy up 3% of all the raw land in Manhattan, right? They would call you a Manhattan real estate hoarder. But it was never our intention to hoard the real estate in Manhattan. It was the intention of people that bought up Manhattan to develop a great city. And eventually you build buildings on that real estate. And the buildings have cash flows, and those are credit instruments. So our company believes Bitcoin is cyber Manhattan, right? It's a place that one day everybody on earth will want to put some of their money. We think it's the greatest city in cyberspace. It's the greatest digital property. Just like if you go to Manhattan and you ask people that live in Manhattan, they think that their city is the greatest city, not just in America. They think it's the greatest city on earth, and people have been buying Manhattan real estate since 1650, every decade for 300 years, and they keep paying more than the previous decade paid, and it's never been a bad idea to buy Manhattan because it is the greatest city. I would say tongue-in-cheek, I only buy Bitcoin with the money you can't afford to lose. So this is the 90th purchase. And so we've done it 90 times. It's a very simple way to think of it. So Bitcoin's been going up about 45% a year for the past 5 years. I expect it to go up 30% on average for the next 20 years. It was going up 80% on average 5 years ago. So it's decelerating from 80 to 70 to 60 to 50 to 40, and it should continue to decelerate, towards something like 1.5x the S&P. And so it's not hard to get to a forecast of about 30% over 20 years. But that being the case, the way I think about Bitcoin is it's a digital monopoly on capital. It's the world reserve capital network that's growing 30% a year that you can purchase at 1 times revenue. I first realized that Bitcoin was digital capital, but digital capital is like, it's like you got a 3-year-old kid and you give them $1 million worth of real estate in the middle of Brickell. It's dirt, no cash flows. And in 30 years, maybe it'll be worth a lot of money. And if you want to get cash flows out of it, you've got to form a real estate development company. You got to design a building, get a construction loan, build the building, market the building, rent out the building, deal with all the politics and the maintenance, and then maybe you get some cash flows. But not easy for a 3-year-old kid. Not easy for most 30 years old. So if you go to the same kid and you say, or the parent, you say, I'll just give you a credit instrument that pays you $10,000 a month forever, starting now. Okay, well, how many people would prefer to have the credit, right? By the way, the world is, even if the capital asset's going up 30% a year, the better deal is take the capital asset. But most of the people, they can't wait 20 years or 30 years with no cash flow. They want the money. So it turns out that converting capital into credit, that is the mission of the company, in the same way that a real estate developer takes a bunch of raw land and turns it into a building, and either the people are living in the building or the person that's collecting the rents is getting paid some steady income. We realize that we're kind of put here to create that digital credit, and that digital credit is then the stepping stone to the final thing. And the final thing is digital money. And the idea of digital money is not 10% dividend yield with a 10 vol. It's 8 or 7% yield with a 0 vol, right? What if I give you a bank account that pays you 7 or 8% with 0 vol? You put $99.71 in, you get $99.71 out. But until you take the money out, you get 4% more than the risk-free rate in the currency that you live in, right? That is the perfect product. I submit to you, I used to think the iPhone was the perfect product, but the iPhone, you got to actually be able to hold it and look at it, and you got to be awake, or maybe be able to hear, or be able to see. But, a bank account that pays you 8% or 7%, you could be deaf, dumb, blind, in a coma, unborn child. You still want that. You want that for your heirs not born for 20 years, right? So what is it that everybody on earth wants, right? And in the English language, there's a word for what everybody on earth wants, for universal utility, and the word is money, right? You want money. Okay, when I give you a bank account that pays you double what SOFR pays you, if I give you double the money market, or if I give you, you live in Japan and I give you 6% or 8% in yen, I'm literally just giving you free money. Okay, I know it sounds difficult. It is difficult. It's like building nuclear reactors in order to give you free electricity or 1 penny a kilowatt hour electricity. It's hard, right? You basically have to create a layer of digital capital, not our doing. Then you have to create a layer of digital credit. It takes a lot of equity capital. The crypto industry struggled against being debanked, for the entire history of the industry. This is just, it's a politically driven action to sort of debank digital assets companies, but really just block them from an index. It's misguided. It's a little bit politically motivated. It's probably being fed by short sellers, but it's not. It's a third order issue. At the end of the day, it won't matter one way or the other.
Saylor says the financial system hit a breaking point during the pandemic when interest rates dropped to 0 and stayed there. He calls that moment a death sentence for anyone holding traditional assets because central banks sent one clear message: your money will earn nothing, and inflation will quietly destroy what is left. That forced a brutal choice: Either accept slow financial death or find a capital asset that governments cannot control or destroy. Saylor's answer is what he calls digital capital. He compares it to owning prime real estate in Manhattan, except it weighs nothing, cannot be taken from you, and moves anywhere in seconds. People have bought Manhattan property for 300 years straight and never regretted it because everyone agrees it has value. Bitcoin works the same way, but better. The real game changer is not just holding digital capital, it is using it to build new financial products. Saylor explains how capital growing at 30% per year can back credit instruments that pay out 10% or more with way less risk and almost no volatility. Traditional finance cannot touch that. It is high returns without the gamble, and that changes everything about how money works. Let's watch more clips from Michael Saylor's interview.
I think this is repeated ad infinitum, and 4-year cycle, 4-year cycle, 4-year cycle. There are certain tropes that keep getting repeated. I think it has its origins in the fact that, Satoshi implemented the halving. 50% of all the Bitcoin that will ever exist was mined in the first 4 years. And then there was a halving, and then 25% came in the next 4 years. And then there was a halving, and then 12.5% came. So one can certainly argue for the first 12 years, it was supply driven because the amount of Bitcoin being put on the market was large by the miners. And then each halving event cut that supply in half, and then then it went to 6.25, whatever, and then it went to 3 1/8 or something. And so we're at the point right now where it's become somewhere in the range of I would say, a second order to a third order driver. The actual liquidity in the market, depending upon your estimates, is like $20 billion to $50 billion are the estimates of daily spot liquidity, and $100 billion of derivatives liquidity a day. The Bitcoin being mined by the natural miners is 450 Bitcoin a day, so at current prices, you're talking about $40 million. So $40 million of supply coming on the market each day versus between $20 billion to $100 billion of trading. It suggests to you that the supply side is not driving the market right now. And if it was, and that's the only argument for the 4-year cycle really, it's being overwhelmed by other structural developments. When, if you think about the annual supply at 450 Bitcoin a day, you're kind of you're in the $16 billion to $18 billion worth of natural Bitcoin from natural sellers available to sell each year. So every time someone buys $16 billion worth of Bitcoin, that's one annual supply. So my company bought more than that. BlackRock's buying more than that. If JP Morgan turns on credit, they will issue $16 billion of credit, and that'll be one more turn. And so if you look at the formation of the credit networks, when the SEC took the handcuffs off of IBIT options, they were crippling the derivatives market for IBIT options on the regulated markets up until like a few months ago. When they first of all, they made it illegal to trade options for 4 years. Then they turned on the spot ETFs, and the spot ETFs grew to $100 billion in like 15 months. Then the options market got to 10 billion, and then in a couple of weeks it went from 10 billion to 50 billion. And so structural things like unhandcuffing or normalizing the options market, turning on, the CFTC just green-lighted native spot Bitcoin trading on the Chicago Mercantile Exchange, right? The CFTC just green-lighted it for regulated exchange in the US, and then they green-lighted the use of Bitcoin as collateral for those transactions. That's going to create 10, 20, 50 billion dollars of increased trading. So the structural changes by the regulators and by the banking and the trading establishment are way overwhelming the 4-year cycle, quote unquote, which is built into the protocol. And so at this point, the thing to be watching is the formation of the credit networks and the formation of the capital networks. And those are all decisions made by the commodities regulators, the securities regulators, the digital assets regulators, the banking regulators, and then watch the action of the big banks. Like Citi announced they're going to start to custody and issue credit on Bitcoin next year. Schwab announced they're going to do it. I think we'll actually see 8 of the 10 largest banks in the US do it in the next 24 months. When they come into the space, they're going to create $100 billion worth of credit each. And so the amount of, let me say it a different way. If you could not get a loan to buy a house in Miami or an apartment in Miami, what would the impact on the price of the real estate be? And if someone said, oh yeah, guess what? Banks are going to start giving you mortgages on houses but not apartments. Zip. And then they said, well, apartments. Zip. And then they said, well, now it's subsidized and it's going to be a conforming rate 200 basis points lower. Prices go up again. And if you recall, what happened when Jerome Powell said, we're lowering interest rates to 0, and the Fed regulators said that the reserve ratio for banks could go to 0 and they could, in essence, have unlimited leverage. And they said that in March of 2020. If you recall what happened to real estate prices? Yeah. So it's the credit networks forming and normalizing around this asset, which are going to drive the asset class right now. And it's not the 4-year cycle. There are dynamics, but the dynamics have to do with the credit markets and the actual trading of it and the formation of derivatives and how they move.
Saylor's biggest warning is not about Bitcoin. It is about credit markets falling apart right now. He breaks down how traditional bonds, corporate bonds, junk bonds, and even government bonds are completely broken. They do not move. They barely pay anything. They carry massive risk, and once you are in, getting out is a nightmare. In Europe, credit spreads sit at just 70 basis points above government debt. Saylor calls this return-free risk. People are not buying these things because they are smart investments. They are buying them because there is literally nothing better in the current system. Digital credit flips that entire model. Saylor explains how you can layer digital capital to create credit products paying 10% or more while cutting out 80% to 90% of the volatility and risk. It works by using capital that grows fast, skimming the first 10% for credit investors, and letting equity holders take the rest. What you get is a credit instrument that crushes traditional bonds on every level while being safer and easier to access. But what really matters is digital money. Saylor describes a future where anyone can open a bank account paying 7% to 8% with zero volatility. It would be backed by digital capital, digital credit, and actively managed cash reserves to smooth out every bump. This would be an actual savings account that protects wealth, something that has not existed for regular people in decades. He believes trillions will flood out of dying traditional systems because the choice becomes obvious. Take 2% that loses to inflation, or take 8% that protects what you have. Saylor also dismisses the popular belief in Bitcoin's 4-year cycle. He explains that the cycle theory was built on mining supply dynamics, where each halving event cut the new Bitcoin supply in half. But today, miners produce only about $40 million worth of Bitcoin daily, while daily trading volume ranges from $20 billion to $100 billion. The supply from miners has become irrelevant compared to institutional buying. What matters now is the formation of credit networks and regulatory decisions that unlock massive new demand, not the protocol's halving schedule. His final point carries the most weight. This transformation will happen whether people understand it or not. The current system is mathematically unsustainable, and when it breaks, those who prepared will be protected, while those who ignored the warnings will face consequences. This is not about speculation or getting rich. It is about preserving wealth in a world where traditional methods no longer function. Now, do you think Bitcoin will become the foundation of a new financial system in 2026, or will most people realize too late what they missed? Thanks for watching. Please don't forget to like and subscribe.